Conference. We had a quick change of scene. I changed my hat. Now I'm no longer a panelist, but I will be chairing this session on digital currencies and the international monetary system. So this is a session where, as Mark Usan said at the beginning of this conference, we will be looking forward. So we look at the past, but also we will look forward at the development of the international monetary system. I found it very interesting. We had the presentation from the governor of the Central Bank of Mongolia, who actually gave us this overview of the development of money from the Khan court to fintech, and it was fascinating. And it's particularly because one thing we actually that the presentation brought home was the physical features of money. Now, we discussed in the previous session the legal framework of money, and it goes a long way back. We talk about the other features of money, but we didn't talk about the physical features. And actually, I would say, probably when 30 years ago the dram was established, probably nobody would thought about digital money, digital dram. This is a bit like Blade Runner, probably a film, 1984, where we had this dystopic view of the future, which didn't include any computer, let alone smartphones. So those was the unknown unknowns. And I believe when the dram was established, the digital money was the unknown unknown. So now we are talking about money that doesn't have is not a physical entity, no longer paper, gold, coins, anything that could use physically exchange, but we talk about something that is up in the cloud, and John allows me to be technically incorrect. I'm not sure if that is the correct definition. So from this premise, it would be good to explore, we will explore in this session, how the international monetary system will evolve. We've obviously taken into account this digital money. We have three distinguished panelists. Harold James, professor of history at Princeton University, followed by Jean-Pierre Landau, professor of economics at Sciences Po in Paris, and finally John Velissarios, founder director of Otranto. We will start actually with you, Harold, and you have a presentation, I believe, and
I have a verbal presentation.
A verbal presentation. Okay, thank you. Thought it was a PowerPoint.
But no PowerPoint. Thank you, that works better now. I hope you heard the first part. I'm a historian, so in some ways I want to look back, and the first thing that I wanted to look back on was the question that you answered at the beginning of the last session. I think you were answering a new question at the beginning of this session, but the first question that you had last time was, do you believe that economic weaponization and the formation of geopolitical blocs will define the 21st century? And an amazing majority, 54%, said yes to that question, that you believe that geopolitical blocs were the future of the whole of the 21st century. I was one of the small minority that said absolutely not. I don't believe it for a moment. And in part, it's because I like to think in terms of very, very broad patterns and very long-term developments. So I've been thinking recently about the long-term story of globalization. And there are really two big pushes in recent history. Some people like to go back to the period of the Roman Empire and think that the Roman Empire was also globalized in the sense that there was certainly a trade connection between Rome and China, and you find people with Asian DNA buried in Sicily and people with European DNA buried in the coastal areas of Vietnam and China. But I don't want to go back that far. Modern globalization really began in the middle of the 19th century and then was interrupted by the First World War, briefly resurrected and destroyed in the Great Depression. And then there's a new wave of globalization from the 1970s. And what it struck me, and it's not realized enough, I think, is that those two moments, the middle of the 19th century and the 1970s, were moments of acute supply shocks, big supply shocks. And you first think that a negative supply shock of the kind that they had in the middle of the 19th century with the most famous bit of it is the Irish potato famine, but it was all over Northern Europe, crop failure, hunger, political unrest, overthrow of governments, enormous turmoil, economic crises, financial crises. At first the thought is you can solve this by yourself in a national setting. But then very rapidly the policymakers discovered that you couldn't do that and that effective policy meant opening up. And so from the 1850s, there was this big process of trade liberalization that really then fueled the globalization of the rest of the century. And the same story in the 1970s. So I remember the 1970s. I was a student in Cambridge University. I began in the year 1975 when UK inflation hit its peak moment. It was 25% in 1975, really amazingly high. And there was a lot of thinking, we need to have a siege economy. We can solve this problem if we just close down the British trade. There was a big discussion in the Labour Party. A leading newspaper, popular newspaper, the Daily Mirror, Robert Maxwell's Daily Mirror, distributed little stickers saying proud to buy British and T-shirts with proud to buy British with the Union Jack on it. And then they discovered that the T-shirts were actually made and printed in Portugal. So it looked like a demonstration of the craziness of this. And by the end of the 1970s, there was more and more a recognition that this was not the right kind of solution and that you needed to do global openness. And I think we're seeing exactly the same kind of response to the twin shocks of COVID and the Russian attack on Ukraine last year, that the first thought and the escalation of tension around Taiwan, the first thought is, yes, this is producing deglobalization, but for reasons that Gian Maria set out, I think, very, very clearly in the last session, and Paola was talking about that isn't really quite what's happening. And the story is not even really properly described as fragmentation. I think the only country that is really trying to deglobalize at the moment is Russia. And it may not be that that experiment works very well. I don't think it will work very well. So Russia is certainly deglobalizing. But I don't see that for China for the reasons that were set out. And people often talk about this, that US-China trade is still rising, although the relative share of China and the US trade has fallen. And there was a really remarkable paper in Jackson Hole that Gian Maria already commented on by Laura Alvaro. And that paper demonstrates, I think, something that might be really central to what I think of as actually a growing consensus that is developing in this meeting. That is that you're not really decoupling, but there are more and more intermediaries, and particularly the story that the Alvaro Chor paper set out was very strikingly focused on two countries, on Vietnam and Mexico, as intermediaries between China and the US. So importing much more from Mexico and then retrading that to the United States. But it's clearly not just Vietnam and Mexico that are in this position. There are a whole range of countries that don't want to be aligned with a particular bloc and don't see themselves as being aligned with a bloc and see themselves as intermediaries and see themselves as a result capable of really quite high rates of growth, and that there's a stability that comes from these regional settings. So this, the conference is 30 years of the Armenian dram, and I think your future at the moment looks actually very good in terms of being able to balance in this very complex geopolitical field. But let me come to the question that Paola raised, the transition of monetary systems, because we really are at a turning point, and Jean-Pierre and John are certainly going to talk more about that. So one of the permanent questions in any meeting of this kind for the last, I don't know how many years, dozens of years, no more than that, the last 80 years or so, was about the future of the US dollar. And so somebody on the first day said, let's rename the conference and say 30 years of the Armenian dream. If you had this conference focused on the dollar, I think you would rename it as 80 years of the American drama, because the Americans are a kind of drama queen. The dollar is always controversial, and ever since the 1960s, people have been saying the end of the dollar. I mean, particularly Jean-Pierre's compatriots were doing that on a big scale, somebody who's not a historian but had a big historical sight was the Nobel Prize winner Robert Mundell. And Mundell had a remarkable lecture that he gave in Geneva in 1969. So it was just in the last years of the Bretton Woods system. The dollar was still the center of the Bretton Woods order. And Mundell made 3 predictions. And people always say you shouldn't make predictions, but he said, number one, the Soviet Union will disintegrate. Number 2, Europe will get a single currency. And number 3, the dollar will remain the central currency of the world in my lifetime. Well, you might say, I mean, sadly, Bob Mundell passed away in April 2021. And so you might say, well, what does this prediction mean? I mean, should we treat this really literally as a kind of Nostradamus prediction that once Mundell passed away, the dollar passes away? I don't think so. The alternatives. What are the alternatives? The alternatives. Sometimes it was suggested that the renminbi will play the leading role, and that there's a kind of succession of hegemonic countries from Britain in the 19th century, or if you go back, Spain or France, or go back further, the Venetian Empire, and then it's the United States in the late 20th century and China in the 21st century. But I think that's looking increasingly unrealistic. And indeed, when Paola thinks about the threat of China, I mean, it seems to me that there's actually a double threat to China. People often talk about the rise of China as the fundamental challenge, and that China as an innovator is the challenge. But it may be that the disintegration of the current wave of Chinese growth in the aftermath of a big real estate crisis is really the moment that we're looking at. And so it's Chinese weakness that is the problem. The European monetary integration, so I've written something about that, some of it with Jean-Pierre. That's clearly a success story, but it's not a success story that is really exportable. And some countries talked about regional monetary integration. in the early 2000s, the Gulf Cooperation Council wanted to do something like that. Periodically, in Latin America, I mean, actually, ever since Simon Bolivar, people have been talking about that, and we've had recent instances. The former Brazilian President Bolsonaro, I think, suggested a currency union with Argentina in order to provide a firm bulwark against socialism. Was the argument that Bolsonaro had for this currency union. But these are pipe dreams. So no regional integration. But actually, what happens, I think, is that there's a lot of innovation, and it's connected with the first bit of my argument, that is that it's the countries on the margins, the countries that are between systems, that are going to innovate most. Another really, really great economist and economic historian, I mean, somebody I think has a lot to say still today, was the Ukrainian economic historian Alexander Gerschenkron, who moved after the Russian Revolution to Vienna and then to Harvard. And Gerschenkron had a concept of leapfrogging. And I think that's exactly right in terms of the technology, that if you're really not locked into existing technologies of money, you have much more of an incentive to innovate. So, for instance, the reason that the British have a really terrible rail system is that they built the first railroads, and so the curves are very narrow and the tunnels are very small, and they can't replace that infrastructure. The United States has the technology from the middle of the 20th century, and it's a superb technology in terms of managing the dollar, but it's not surprising that the United States is among the most resistant countries to going over to a digital currency. It's skeptical about, on the whole, about central bank digital currencies. You mentioned, I think, the House of Lords report in the UK that was pouring cold water on the idea of central bank digital currency. It's elsewhere that the innovation is occurring, and we've heard quite a lot in this conference already about that innovation in Mongolia this morning, in Kazakhstan. This is actually where you need to innovate, because if you think of where you are in Kazakhstan or Mongolia, for that matter, you don't want to have a currency union with the country that's next door to you. You want to do something different, but you don't want to simply be part of a dollar bloc either. And so this is really where the innovation is going to happen. And it may come from governments in those areas. If governments really respond to the needs of the population, and if central banks are institutionally aligned to do that, they can provide this. But if they don't, somebody else will do it, and it will be a private sector system that does that. And where you don't trust the currency, where you can't deliver on stable currency, you will go to the private sector, and then you will have private digital currencies that may form big areas. And Jean-Pierre's thought about that. Our friend and colleague Marcus Brunnemeyer has thought about that, but it's quite conceivable that you can get digital optimal currency areas where you unite a large group of people across borders who have certain characteristics in common, that they want to share information about themselves, and as a result of that they get the benefits of locking themselves into an absolutely stateless currency system. So if you're thinking about innovation, I think in the longer run that is the only effective challenge to the US dollar. That the euro is not going to do it, the renminbi is not going to do it, regional currency unions are absolutely not going to do it, but the private sector can and will do it when governments fail to be able to do that. Thank you.
There are lots of interesting points. Again, perhaps something to be discussed later. There is also Robert Mandal's quote that says great nations have great currencies, and what we have now is China, the second largest economy in the world, without a properly developed international currency. 10 years ago we used to talk about the development of multi-currency monetary system. Now there is this possibility is still on the table, but with the innovation you just described. So perhaps we can come back later to that, and I know then John will talk about China and the innovation in digital currency. But now I turn to Jean-Pierre for his presentation. Now there is a PowerPoint presentation. Thank you.
Here? Is it? Yeah. Thank you. So I'm very glad to pick up where Harold just left. This is a conference about the anniversary of a currency. And apart from giving us a splendid hospitality, I think our host made very clear how important for national identity in this period to have your own currency and to have it well managed. And I thought I would elaborate on that on the theme of monetary sovereignty. What does it mean to have monetary sovereignty in a digital world? And I subtitled, there is a dilemma. And the dilemma was very apparent through what Harold says and the conversation this morning. Because the public doesn't mind. The public doesn't see the utility of having a digital central bank currency. The public is extremely happy with using private means of payments, private apps available on your mobile, and functioning that way. There is no sound business or use case for a CBDC. And the exchange with the Italian colleague on screen was pretty obvious. And on the other hand, if you're a central banker, you cannot ignore the fact that the monetary system rests upon a public currency and the availability of the public currency in the economy. And in a digital world, if everything is digital, the public currency has to be digital. Otherwise, you lose what I will show in a minute, your monetary sovereignty. So this is the dilemma between something the public doesn't see the necessity of, and maybe the central bank at some stage will see the necessity of. And we are reaching, at least in the euro area, it's perfectly clear, we are reaching that stage where the central bank is pushing. It sees the case, and in my view, rightly so. But the public, and of course the financial sector, in a way, is pushing back very strong. So to understand what that means, we first have to look at what is monetary sovereignty. And monetary sovereignty is usually defined in terms of monetary policy, the famous Mandel trilemma. If you want to conduct your own monetary policy and have open capital accounts, you must have flexible exchange rate. If you want to have fixed exchange rate, you must have closed capital account. But there is something much deeper in monetary sovereignty than that. And you can see it when you consider the opposite, which is dollarization. You have monetary sovereignty if your population, or at least the most part of it, count in your own unit of account. If wages are denominated in your own unit of account, if prices are denominated in your own unit of account, if debt is denominated in your own unit of account, then you have monetary sovereignty because the central bank can control the value of the unit of account. If most of the transaction or debt or stocks in the economy are denominated in a different unit of account, what the central bank does doesn't matter much, and then you lose monetary sovereignty. That is in my view, the most important and fundamental definition of monetary sovereignty. So that means two things. That means two things, basically. The first thing is that the unit of account is the liability of the central bank. It's a deposit of the central bank. And second, that all the other forms of money relates one way or another to that unit of account. And that is what's called a uniform currency. You must have a uniform currency. Every payment instrument, whether it's private, public, digital, physical, intermediary, whether it's a claim, whether it's an object, it has to be denominated and have the same value, whatever its form. That's a uniform currency. And people now in Basel use a different term, which is the singleness of money. And for those of you who are interested, it goes back to a 2003 report by the Committee of Payments of the Basel Committee of Basel. And it was an introduction written by Tommaso Padoa-Schioppa, where he develops that concept of singleness of money. So you want to have a single uniform currency. Uniform currency is part of the mandate of the Fed, explicitly. You want to have a uniform currency, and you want to have your unit of account counted and used by your population. That's very important. And it could be taken for granted until recently, because everybody thought a bank account was equivalent to a banknote. There was no problem. Then came digitalization, and digitalization threatens the uniformity of currency, and therefore it threatens, in a way, the monetary sovereignty of the central bank. There was a very interesting moment 18 months ago where a number of head of states of the European Union wrote to the president of the European Commission asking her to take a bigger stance, more aggressive stance, on the transfer of data on payments between Europe and the US. And they wrote that sentence, which I've just quoted here, which is fascinating, which is, data is the new currency. Now, I don't think that's accurate, but it tells you that in a digital world, and Harold alluded to that, the problem of the propriety of data and the problem of monetary sovereignty may be intrinsically and closely linked. And then, of course, you have the payment system themselves. So the nightmare scenario for monetary sovereignty is a payment system which sets up in your territory and start denominating the payment in a country which is in a currency which is different than yours. And of course, that nightmare scenario almost materialized 2 years ago, because that was the attempt that Libra was taking to make. Libra was basically exploiting the network effect of 2 billion Facebook users to create a new unit of account and use that unit of account into cross-border and domestic transaction. And that was the reason, in my view, why Libra was killed. It was killed because it was a direct threat to monetary sovereignty, because it has its own unit of account. If Libra had been smart enough to develop based on an existing official unit of account, for instance the dollar, I'm quite sure they would not have met with the same kind of resistance and with the same kind of opposition. And actually I had the opportunity to talk with the creator of Libra, who happens to be French, David Marcus, and I told him that. I told him, you know, you're going to meet with resistance because this is a direct confrontation of central banks. And he dismissed the argument. And it's very interesting. And he made the business argument that having a basket of currency would allow people to hedge their position, and it would increase the attractiveness of the monetary union. And from a business perspective, he was absolutely right. From a technical perspective, he was absolutely right. But if you forget the monetary underpinnings of what you're doing technically, then you go into a direction which may lead you to an impasse if central banks do not accept it. And you have that too at the moment, and some discussion taking place, including in Basel. So we have colleagues in Basel who are so fascinated by the technology, and they're right so, that they want to promote programmable money, right? Programmable money, so it's money, you can send money, it has a validity date, or you cannot use it to buy alcohol, or you can do whatever you like, of course, with a digital token. And I keep having this dialogue with them and telling them, programmable money is not money. It's something different. It's a token which is used for payment. It's not money. So you're undermining your own sort of function. You're creating diverse currency denominated in the same account. You're undermining the uniformity of currency. It's very hard to get them to understand that. So the thought experiment that you want to make is, what if Libra had developed based on the dollar, right? What if the 2 billion Facebook users in the world had instant access to a digital token denominated in dollar that they could transfer all over the world? That's a digital currency area as Harold has said it. And that would have been, of course, a general dollarization in many countries. That's why you don't want that. You don't want, as a central bank, to be in the dilemma of having very modern, very easy to use, very practical private tokens, digital, and have only as public money something which is may become increasingly obsolete. And so that's the problem that central banks today have to solve. And I think my intuition, and Harold alluded to the center and the periphery, my intuition is that medium-sized countries and small countries have the biggest interest in moving ahead than large areas, because you are more exposed, they are more exposed to the kind of external digital competition that those networks can bring. So the recent story is very interesting. I've called it. I've borrowed a sentence from Star Wars. The Empire Strikes Back, and Libra was killed, and it was killed by 1,000 Kurds. Nobody ever said to the Libra, "We don't want you." But, oh, why don't you meet those 25 regulatory requirements? Then when they met the 25 regulatory requirements, oh, by the way, we forgot there's another 15 that you should meet, and so on and so on. And it was made clear for some major partners that they could not proceed, and the project died. But again, if they had been smart enough, and that may happen in the near future, to have a global stable coins, satisfying all the requirements of financial stability in the US, denominated in dollar, with, for instance, access to the Fed balance sheet, right? What would be the picture? So, contrary to many of my countrymen, I don't believe the dollar will die. I believe actually that this is the kind of scenario which may very well develop independently of all the attributes of the dollar as a store of value. And of course, the renminbi could do the same. But as I said, as Harold said, the relationship now between payment, money, data, and information is so strong that before allowing the renminbi to be used as a universal medium of exchange, a lot of countries will think twice, because we know that data can be subjected to some kind of exploitation. But I have some Chinese students, right? When they invite me to take a coffee, they recognize and they acknowledge that there are Chinese stores in Paris where they go, they have their Chinese app on WeChat or on Financial, and they pay with that, the account being in the token being kept in a ledger in Beijing. And the prices are quoted in renminbi. So it's total attempt to the monetary sovereignty of the euro. It's very anecdotal, so we don't pay much attention to it, but it's clearly a sign of the things to come. So what would be in kind of decision map of any central bank who would think about the issue? I think you want to ask yourself 3 questions. The first question is whether cash will disappear or not. If you still have cash as public money, which the public largely use, you have the public money you need to ensure the uniformity of the currency. If cash disappears, and my feeling is that it disappears with much greater speed than we would have expected in the past. There are discontinuities. I now find myself in the US very frequently denied a payment in cash for buying a packet of chips, you know. So cash is disappearing very fast. Then you have the question of whether public money is necessary. The second criteria is whether you face possible digital competition from outside. And this, I must say, the largest countries are less exposed to that than the medium-sized or small economies who want to keep their monetary sovereignty. So the candidate for a CBDC is a medium-sized monetary country which doesn't want to be dollarized. And of course, that's exactly what Harold said. This is no coincidence. These are the more active in promoting. And third, whether you are prepared to regulate big tech out of existence or whether you want them on your territory. And that is the endogenous factor which will drive your CBDC. At the end of the day, countries will have to decide whether they want to compete with the big tech in terms of public money, and that means CBDC, or whether they want to regulate them out, which is possible too. And I think this is a very much open debate, especially in the euro area. And I was trying to sort of figure that. That's my last slide. The kind of strategic game which unconsciously I think people are playing in the euro area between three actors, the central bank, the banks, and the big tech. And the banks are actually at least the French banks, but many of them as well, are pushing back very, very much against the central bank and its desire to create a digital central bank currency, a digital euro. And the reason they're pushing for that, in my view, implicitly, is that they don't think they will face a competition by the big tech. And so if they think they don't think a competition by the big tech, they don't need a central bank digital currency on which they can take advantage and take support, So implicitly at the moment, there is in Europe this idea that we will not allow large global stablecoins to prosper in the euro area. But if that's not the case, if the central bank promotes efficiency, if the regulatory authorities promote the idea that big tech should be allowed to take a large place in payment, that global stablecoin should be allowed, then I would say, if I were a banker, I would find it in my interest to have a central bank digital currency and to keep on the digital field the same kind of relationship that I have in the fiduciary field, meaning having bank currency directly convertible into public currency and ensuring the place of the banks in the financial system. So that's my conclusion on that. It's a very crucial period and difficult period. Of course, the technicalities are fascinating. The idea which has been mentioned of having platforms, interconnected platforms, facilitating cross-border payments through CBDC, all this is very important. But at the end of the day, I think the dilemma which central banks are confronted is how to ensure uniform currency, how to ensure monetary sovereignty in a digital world dominated more and more by private network.
Thank you. Thank you. There are two important points, and I think I'd like to pick up now before turning to John. One is actually, again, I think the difference between domestic central bank digital currencies and the ability of small countries to innovate, and in particular help financial inclusion. I'm thinking about what is happening in the Caribbean, where all the Caribbean nations have adopted central bank digital currencies, again, very much for financial inclusion. And the other thing is the cross-border use of digital currency, which is something which obviously is going to affect the international monetary system. The other point you mentioned, Jean-Pierre, is the role of cash. And I think of cash in terms of anonymity. Cash is sovereign in the moment that you don't want to be, you don't want your transaction to be tracked down. And so the issues about big, about in particular the clamping down on big tech in China was very much linked to data. So who owns the data? And there is a whole issue about governance. And again, central banks will have, through the digital currency, will have access to data which are potentially very sensitive. So again, how do we govern to ensure that these data are managed in an appropriate way? John, this is all thing for you to pick up, but perhaps before turning to you, I would like to see if we have the result of our survey and if it's possible to be put on the screen. All our questions, yes, here. So do you think that the nature and severity of future crises will be different because of digital currencies, assets, and decentralized finance, and why? And sorry, I can't read that far because I don't have it on that screen, but we will see the result of this. Oh, the vote is not closed, yes. Sorry. In that case, John, you have the floor while we're waiting for the participants to vote. And,
thank you.
On this.
I'm going to stand, if you don't mind. I'm going to put it up here. First of all, I just want to say thank you very much for the opportunity to speak here today, Mr. President, Governor, and Central Bank of Armenia staff. It's a great honor to be here today with you and to share my experiences that I've gained over the last decade on this topic of central bank digital currencies. And congratulations on the 30-year anniversary as well of the DRAM. If we can put our slides up that we have. Okay, fantastic. First, I just want to say a few things. I'm going to move on to this. Just a quick introduction. I'll go back here. So why am I here? I've spent the last 10 years of my career in working in a big consulting company, focusing exclusively on the topic of digital currencies and digital assets. And I've also worked on about 15 different implementation projects for central bank digital currencies that span in every continent. So I have, I guess, a good perspective of what's going on in the world regarding this topic. And I've also stepped away from the big consulting world. I'm a recovering consultant now. I have slides, of course. But I want to share with you sort of my experiences and also what I've seen over the last few years regarding this topic. First thing, before we get into specifics, I want to make a very clear distinction. There's a lot of stuff that's happening still in the crypto space, and I know this hasn't been a topic of discussion in this conference, but it's something that continues to sort of capture the imagination of many people still, and it should not be ignored. I think there's a lot of interest still in this area, and it sort of overlaps into a certain degree with regards to CBDCs and digital currencies. We also see a lot of, I guess, activities with stable coins, whether they're deposit tokens or stable coins specifically in the financial services or non-financial organizations that are issuing them, and they come with their own degree of variable risks associated with them as well. And finally, the main topic of conversation is the central bank digital currency, and here I've put a few sort of really key messages, and we see this as a third format of money. So it's obviously not a reserve in a digital reserve in an account held at the central bank. And it's not a banknote, but a digital version of that banknote. So it's the third format of that money, and it's very different in nature, and that's hence the reason why we sort of see a lot of the debates that we have regarding this topic. We also, and this we can talk about tokens accounts, which I think was mentioned once in the last day or so. But digital bearer instrument, and this is also where we see sort of the real innovation behind the CBDC, whether this is actually a bearer instrument that someone can actually hand over to somebody else, and it's final, the transaction is complete, and the transfer has been done. There's a number of other points here. I won't go through them in a lot of detail, but the idea, there's a lot of attributes that are specific to a central bank digital currency, and things like offline payments are key. The level of privacy associated with them is also quite important, and there's also an element of interest or not regarding that. But before we sort of get into a bit more details, I want to give a background about why we see the context, basically. Why is this taking off? And where is it going as well? So there are a few things that I just want to anchor the conversation around. The first one is around a lot of inter-regional trade happening in certain geographies. And that's been going on for obviously a long time. And then there's also a lot of financial flows that go back and forth. And the question is always asked, why do we need to basically transact in third-party currencies? Why can't we just transact between ourselves? If we have a lot of flows that are going back and forth between our two countries, can we use perhaps a digital currency that we have that we've implemented in order to do that? Population growth as well in terms of regions. We're around the world. There's a high concentration. Things are growing in certain geographies and declining in others. And it was mentioned once, the BRICS, I guess, it's not something to be ignored, I think, as well. I mean, there's a lot of questions around what does that actually look like in the future. whether they actually issue their own, but also the economies of the BRICS nations, and also the number of members that are being added potentially in the new year, including sort of central banks in the Middle East and other geographies as well. So going back to sort of CBDC, I want to talk about privacy and anonymity a little bit. It's a key requirement for sort of in any implementation. Especially on the retail side, there's a lot of anxiety. You see a lot of news and articles and people saying, well, you know, I don't want the government to surveil what I'm doing and so on. So having a level of controllable anonymity is absolutely key. And the question is how much or how little. And then obviously that has to factor into any type of implementation or solution. The other one is around offline, so ability to pay each other in an environment where there is no internet. Actually, it's one of the key requirements that I've seen very early days in some of the projects where the requirement was, what happens if the network, everything goes down? Electricity and the internet, everything goes down. How do I continue to transact in a digital world when I have no more banknotes in circulation? That came as a requirement at the very early days of the Swedish e-krona project. They wanted to have it as a fallback mechanism. So it was an important fundamental requirement. And then finally, I think many sort of CBDC projects really try to capture the sovereign payment rail. So not being dependent on sort of other organizations outside of your geography specifically, or even commercial banking institutions, but having a digital format of money that you allow the population to use between each other. And that is an independent sort of payment rail. And that's sort of one of the key sort of requirements that we see. This slide was shown earlier in a different format. But the reason why I wanted to show this is that there's about 146 projects that are happening around the world. I tallied it up quickly. It's the latest one. It's a public reference. A lot of activity happening here, and all in various stages. And some of them are in still research stage, some of them in pilot stage, some of them in implement stage. But what's important to recognize, I think, is that this is growing year after year, or actually month after month, in terms of the take-up of this. And obviously, in terms of launch, there's only a few officially launched, but there are a lot of pilots that are happening. And the one I want to mention is the one in China. We came across this in the work that we were doing with Mbridge project with the Bank for International Settlements, and we had interacted with the People's Bank of China, Hong Kong Monetary Authority, Bank of Thailand, and Central Bank of UAE. And we were very surprised at how very advanced the whole implementation of the People's Bank of China's solution had been, and how many people they had working and had the technology and innovation that was behind that, on top of what they had also rolled out in domestically as well. And I think here, just to give some numbers as well, there's I think 240 million users using. That's a big pilot, if you ask me. Of users using it in China. I don't know to what degree. I mean, I think their take-up initially was a bit higher, and then daily usage is tapered. But regardless, I think this is a question of volume and transactions and so on. And I think India is not far behind that as well. I think India will be a big player in this area. And even this morning, I was reading that one of the commercial banks had integrated with the digital rupee into their platform as well. So you see, even though it's a pilot, there's large-scale pilots that are happening as well. And then obviously even proof of concepts and so on. And I'll talk a little bit about Kazakhstan in a second as well. This is where I've also been very fortunate in my time to also have been working on the digital Tenge project since its inception. I'm actually the chief advisor for the National Bank of Kazakhstan, and have been very impressed at the degree of I guess focus and commitment to actually rolling this thing out. So in the last couple of years, there's been a lot of work around the pilot side of things, so implementing, testing the pilot, proving out the point, making a decision. This year is about a production rollout, so consumers and retail users using it, using this in a production environment for specific type of niche applications like social payments, social vouchers, and things like that, and also payment for payroll as well. And then also looking at R&D areas of integrating it into the global financial system through the exchange, organizations such as SWIFT and BIS and stuff like that, which are experimental at this point. They're not production, of course. So important because I think as one of the most advanced projects trying to cover a tremendous amount of scope, but also committed to actually rolling this thing out into production. And it's the beginning, I would say the beginning of a very long journey, but it's still a very big step for Kazakhstan. You mentioned something was mentioned earlier on about Jean-Pierre mentioned earlier on about sort of the usage of digital wallets. I think in Paris, and I see this actually a very interesting point, because actually in reality what you need in order to be able to use a digital currency is a wallet infrastructure. Now imagine China obviously rolling out its digital renminbi more globally, or using it more globally, can enable that through a wallet infrastructure. So if the language permitted it, you can download this, and if you figured out how to use it, you would basically be able to get paid in digital renminbi in your digital wallet. And then integrating it with WeChat Pay and Alipay, be able to spend it as well. So you already have the gateways today. If you go to major cities around the world, you can pay with this already. So the infrastructure is already there. So being able to use this on an international basis is not a far stretch of the imagination. We also see other things, of course, around the Belt and Road and China's ability to influence sort of a lot of the supply chain, or the flow of goods and services and monies back and forth along the Belt and Road Initiative, and there's quite a lot of countries involved in that, and ultimately sort of the currency wars that you see on this slide here. I only have a couple more slides, and then I'll stop. But I want to focus on a few things on this slide here, as sort of maybe not de-dollarization, but maybe relying less on the dollar, I think, in terms of these transactions and flows. The reason for that is because of the flow between countries and the ability to use currencies issued by various central banks between each other. And I think that's an area where there's a lot of opportunity, and regionally we see a lot of interest in doing that in different pockets around the world. Also the thing is around sort of the resilient infrastructure, being able to use sort of a CBDC as a backup, but also as a parallel system for enabling sort of payments in a domestic context, enabling sort of this sovereign sort of payment rail, but ultimately impacting obviously the global financial system, because you have a separation of that, because you no longer need to sort of rely on it sort of exclusively. And then finally, I think on this slide, just talk about sort of the maturing sort of landscape. This has been an ongoing, the technology is more than ready, I think, in terms of implementation. The one thing I have observation around the technology is standardization, or lack thereof. I think there's multiple solutions being implemented. However, there are a lot of also projects that look at interoperability between all of the different implementations. And I think there's like Mbridge as an example. There's multiple other projects that I can reference as well, Project Jura and others as well that looked at interoperability between sort of multiple implementations. But the technology itself is ready for this kind of rollout and implementation. And the role of sort of this new digital currency, and I want to leave you with sort of a pre-final thought on this, is that we see a lot of people looking at how to use digital currency for doing the same things that they were doing before. So just replacing sort of the business functions, the roles, or the transaction with this new digital currency. But I would encourage you to look at how do you use this for doing new things. So not doing old things with this new tech, but doing new things with this new tech, because this is where the true potential lies. And I think this is where the topic of potentially programmability comes into the story, and so on. And finally, this is where we also see sort of the collection of countries coming together, developing sort of this regional hub story of flow of goods between each other, and how they use multiple currencies between them in order to settle trade and flows between them. Thank you.
Now, before opening the floor to questions, I think it's time to look at the result of our survey. I guess the voting is closed. So do you think the nature of severity future crisis will be different? May I ask to show this slide on these streams in front of us because we can't see it otherwise. Disappeared. I think we lost the result of the survey. Here we are, thank you. So, yes, so the 45%, because Horizon's Horizon complexity and all the others. So basically, people in the room here thinks that the digital currencies will actually create more instability and will make future crisis more severe. So that's an interesting result, and perhaps we can pick some of these concerns in our discussions. And okay, now the floor is open for questions, and we have one there.
I was struck by the contrast between Jean-Pierre and John in the presentations, and it almost seemed like they were presenting a different universe, but of course there's a common thread. They were just looking at the same thing from completely different directions. Now, I have been to attended a number of panels of these topics, and one thing that always comes up, at least in Europe, is China, and China's use of the digital renminbi as a projection of its global power, including the Belt and Road Initiative, etc., and whether then the Chinese payment infrastructure would be used as a part of that. So so I was wondering if I could ask the panelists whether they can connect the topic they've been discussing to the projections of a global power, not as a sovereignty issue, not as a technology issue, but as a geopolitical issue.
Okay, thank you. Any more questions? Yes, please.
Yes. I have a question to John on the CBDC. As you said, resilience is a major feature. And if that's true, then also the offline use is of the utmost importance. How would that work in practice? How would it look like? I think you mentioned Sweden as a point in case. Thank you.
Can you please pass the microphone to the next person? Thank you.
My question is about, so there are various models for retail CBDC. So do you think that issuing digital money to citizens directly from the central bank is a good idea, or the intermediary model is much more robust because it will not dismantle the existing financial infrastructure? So what you see around the globe, how is this moving?
Yeah.
Thank you.
Thank you. And then there is a question here, and then we'll close this round, and then we can go back again.
Excellent presentation. A question. We've seen a number of private CBDC, private digital currency platforms crash and burn in the last couple of years. In the event of a regional platform with different governments involved, is there any rule for some sort of lender of last resort protection to resolve the collapse of a public platform?
Thank you. Shall we start? So maybe this from you, John, and then Jean-Pierre and Harold.
Okay. So I'll start with, I made a note of the questions here, but I'll start with the various models for a retail CBDC. And I think, as I put it in the slide before, there's a strong preference for an intermediated model. It is very rare that we've seen anything around a direct model. Actually, there's only one example of where, actually one case where it was requested, but the majority, if not almost all of the cases, are all around intermediated. So this is a two-tier sort of model where you use the commercial banks to distribute money into the economy, just like the way you would distribute banknotes. The same thing, so same sort of model. And I think that's it's a model that is becoming sort of widely accepted and also widely implemented in terms of the different CBDC sort of projects that we see. I'll answer the offline question as well. If I think that's it's a long answer. I'll try to keep it very brief. It's a very security-oriented question around risk of where the wallet is held, and if it's a single offline or double offline solution. So if both you and I are offline, how many transactions can we perform in a group before at some point you either exhaust the capacity of the container that you're using to store the tokens at the end, or that some risk-based decision is made that you must go online afterwards at some point. So it is never meant to be perpetually offline. I think there's a risk around that I think is not an acceptable risk, but it's meant to cover a certain period of offline activity for disaster scenarios. So power goes out, electricity goes out. The burning question is, how long can society survive? Is it a 2-minute, 2-hour, 2-day, 2-week, 2-month sort of thing? And I think that's the debate around that offline sort of story. But there are a number of technological solutions to address the offline, both in traditional payments, but also in the CBDC world as well. But it's a lot. There's a lot more to that answer if you unpack it as well. And I'll cover the China question as well, and hopefully I try to give enough examples of different things around the projection of its global power, and through the Belt and Road Initiative, plus its ability to issue this digital currency, have the wallet infrastructure in place, and then also pay suppliers as well. So try to renminbiize sort of the whole supply chain on many dimensions. And I think this is a very interesting power play, potentially, a projection of power for China and into the global sort of environment, global context. And it has the mechanism by which it can do that, not only sort of the endpoints where they're paying for goods, raw materials, or whatever it is in renminbi, potentially, but also they have made large investments in Belt and Road Initiative, ports, and various things in which they can influence that as well. So I think this is also part of the story of why I wanted to share some of the slides on the slides that I had before.
Actually, one thing I'm not clear about, do you see a hybrid system where you can see digital and physical, or you actually looking forward, do you see a system that is totally digital?
If you look at Sweden, you'd think everything is going to be digital, but I don't see that happening everywhere else in most economies at this point in time, simply because cash has a role. I think people continue to use it, and this is a complement to cash. In Sweden, it's a completely different story. But even having said that, I think in remote parts, they still use some degrees of cash. And the decision about whether to pursue an e-krona was, even to study it in terms of the pilot, was because they wanted to. The question was, if we stop printing banknotes, what happens to society? That was one of the key questions. And so that's a fundamental thing, because you marginalize a potentially a small percentage-wise, but a group of remote people who may not have access to digital or financial services. And so that has social and societal implications. So it's a long answer. I don't see there's a lot of, I think over time things will become more and more digital, but I don't see cash in banknote form will ever disappear, I think, in most cases where we see that.
Thank you. Jean-Pierre.
Yeah, maybe first on financial stability and the digital money. I'm sorry, a bit too abstract. When does currency create financial stability risk? It creates financial stability risk when people don't trust the value of the currency. And there are some form of currency whose value becomes doubtful. And we have an experience of that. Of course, this was the banking crisis of the 19th century. All the banking crises of the 19th century. Suddenly, you have the banknotes issued by one bank in Texas, which was not exactly the same as a banknote issued by a bank in Massachusetts. And people starting running on one to the other or from the other. And that may happen in the digital world with everybody issuing tokens denominated, hopefully, in some official currency. But if you don't know exactly, if you don't have a good reason to trust the value of this token, then you will have this kind of problem. So I mean, under the control of Harold, what his story tells you is that you create financial stability through money when the value of money itself becomes doubtful, when the value of the money instrument. And that digitalization allows you to diversify immensely the forms of money, and therefore the question of value is multiplied by this diversity. And I think it's very important to understand that for me, it's the reason why you want to have a public digital currency and have rules which attach the different forms of digital currency to that value. And by the way, I cannot resist making a sort of attack on MiCA. MiCA is a regulation of cryptocurrency by the European Union. And that regulation is totally misguided because it sort of sanctifies the different form of currency with different regimes. So if MiCA is implemented, each of us in Europe, we will be able to have a token issued by any money issuer, a token denominated in euro, a token issued by a stablecoin issuer and denominated in euro, a token issued by a bank denominated in euro, and those three tokens will not have the same legal protection, the same deposit insurance, and the same prudential regime. And this is a huge mistake. And if you read the opinion that the European Central Bank has made on MiCA, it's written in very diplomatic terms, but it's basically written, it says, you don't understand what money is. Money should be uniform. So that is really, I'm sorry to be so abstract, but it's very important that in the future, when we have €1 or 1 dirham or $1 in our mobile, we don't have the single possible doubt about the value of this, the nominal value of this. But the real value is a matter of monetary policy. So that's my first remark, and I think it's very, very important. So if we want to minimize the financial stability risk that digitalization causes from a currency perspective, that's what we have to do. And then on China, just 2 points, because I think it's useful to distinguish between 2 steps in the reasoning. Will the renminbi internationalize? First step, the renminbi may internationalize as a medium of exchange, not as a store of value for all the reasons which have been explained this morning. So, is an international money viable only as a medium of exchange without being a store of value? That's a theoretical question. I'm not going to develop it now, but I don't think so. So, but let's say it's possible. Let's say it's possible. Then, will many countries now tolerate to have renminbi apps operating on their territories with under the supervision of Chinese Monetary Authority? And the answer is, of course, no, because of the data question and the privacy question. So what Harold said a few minutes ago is actually very important. The currency area will be determined largely by our attitude towards data. And then one last word about privacy. This is certainly a conundrum for the digital euro and for the people who are going to issue it. That's part of their dilemma as well. That's a huge part of their dilemma. They want to ensure privacy, but not too much, because they are subordinated to the legislation on money laundering and private finance. And people, strangely, don't trust the public authority to respect privacy as much as they would trust Visa or whatever. That's the strong. People don't know when they use Visa, which I use daily with great satisfaction, that the data goes into the US. And so the very breach on data protection is actually our payment system, and we don't have. So I think the question is going to be a question of governance. If you want the digital euro to succeed, you want to have a governance system which ensures privacy and which is totally outside the central bank and outside the regulatory authority. It should be a separate authority with its own legal framework. You don't need to have many monetary specialists. You may want to have a few of them, but you want to trust that authority as totally independent from authorities which pursue money laundering, which pursue terrorist financing, or which implement monetary policy. For me, that governance issue is essential to the success of digital euro.
Paola, can I comment on the privacy topic? Yeah. In my experience, working on the e-Krona project, when I started working on that project years ago, the word privacy was not mentioned a single time at the beginning, early stages of this project. And I was working with my colleagues on this, and Swedish, of course, and I was asking them all about privacy, and they said, well, why do we need that? We trust our government, implicitly. And I was like, wait a minute, I'm Greek origin, right? So South Mediterranean, the trust in government varies greatly from the south to the north. And you see this across the Eurozone. So there's a lot across the European Union, a wide degree of, I guess, the basis of trust for government and central banks and institutions that are issuing and transacting with personal data and transactional information. So it was an eye-opener for me. I didn't expect that answer, actually, from my Swedish colleagues. I said, well, and it was confirmed over and over again. And I think you look across those requirements, I think across the board, and I think we have to take that into consideration. So it's not one size fits all from a privacy point of view either, I think, at the end of the day. I just wanted to comment on that.
So three questions that I thought emerged out of that cluster of questions. Starting off with John's excellent point about the digital renminbi and whether that was an attempt to project Chinese power across the world, and clearly it was. I don't think there's any doubt about it. I mean, it was very, very explicitly formulated that this was the way that the Chinese were going to challenge the US dollar. In the same way, actually, some people in the 1990s suggested that the euro was the way that the Europeans were going to challenge the US dollar. But there's a kind of trade-off that it was almost impossible for the Chinese authorities to work out, which was that the success and the attraction of this project and the technical innovation of it depended on the way in which the Chinese private sector was driving it. And then that becomes a threat to the Chinese system itself. And so they steer back on that. And as they steer back on it, the chances of this then becoming the international currency really recedes. And so it's a kind of game between the political authorities and the government and the private tech giants. I mean, in a way, my answer to the lender of last resort question is sort of similarly, I think, structured in terms of the way we should think about it, because you didn't need a lender of last resort for long periods of time. So early modern Europe had very, very complicated payment systems, but didn't fundamentally have lender of last resorts. You need the lender of last resort the moment that you start to get banks and that you start to have banks doing maturity transformation. And that becomes the critical element. So the attraction, and one of the things that I think you would sell the kind of digital system to, is that it actually gets out of the world of the banks. And so, if you look at Jean-Pierre's triangle, that's exactly what the triangle is saying, that we get away from the world of the banks. And so we don't need the lender of last resort. And, as Paola was reminding us, we're in a horribly difficult situation now because we think that a potential financial crisis, if it's a global financial crisis, is just so big that we can't imagine any possible lender of last resort. And so, we have a real crisis there. So in that sense, the argument is a kind of back to the future argument about unpicking the way in which banks that did maturity transformation became the center of the financial system in the middle of the Industrial Revolution. And so the Industrial Revolution was really driven by banks. They were the only things that were capable of really raising this amount of capital in order to finance industrialization. And the thought is that you can leapfrog that and you can get out of the world of banks again. So the world of the tech giants is fundamentally a world that's looking at ways of replacing a conventional banking system. And that's, I think, the explanation of a lot of the political tension in that system. And finally, the hybrid system question. I mean, I think, John is absolutely right. And historically, again, I think we don't necessarily have this beautiful idea of a single money. And people use money for very different things, and retail payments are different than wholesale payments, and you can have a quite messy system, and indeed that's what many countries for long, long periods of time had with multiple currencies, and it's a kind of complex world. Thanks.
To be clear, just a footnote on the clamp down on big tech in China. It was a complex policy decision due to many reasons, including the power game with Jack Ma. But the reality was then the fintech was so advanced, then both WeChat and Alipay were actually acting as lenders. And effectively they ran a money market, parallel money market to end system. And at a certain point, in particularly around 2012, there was a big concern. There was actually potential problems to financial stability, because these were money that was basically out of the banking system supervised by the central bank. That was one of the reasons why the authority decided to clamp down on the big tech. This is to say, then again, the fintech in China was so far advanced compared to what we had, certainly in Europe, then they ran a parallel system to the bank. It was actually the so-called shadow banking at the time. Now, we have a bit of time for just a couple of other questions, if there are. No, really? Well, in that case, I'd like to go back to one of the points that emerged in your remarks, and it's again the issue around money as a store of value, the third function of money. So again, it looks like these fintech, digital currencies are very useful as payment system. Mm-hmm. So again, Jean-Pierre point about unit of account and means of exchange, but they are less successful at the moment as store of value, and this is a critical issue. We already discussed this in the previous session for China and for the developing of the renminbi as a proper, fully fledged international currency. So a currency that non-residents are happy and willing to hold as a store of value. So, Jean-Pierre.
This is a very interesting question. I'm very skeptical that you can develop ultimately a huge payment system, an international money, which is not a store of value. And you see what's happening with China right now. Some countries are developing invoicing in renminbi with China, or paying in renminbi with China. Mm-hmm. Now, in that case, let's say you have a surplus with China, so you're accumulating renminbis. So Russia is selling oils and getting paid in renminbi. So what do you do with these renminbis? That is the big question. And that's where the synergy between medium of exchange and store of value comes into play. If you sit on 20 billion equivalent dollars in renminbi, what can you do with them? Almost nothing except buying Chinese goods. And then, of course, you're in a position in terms of negotiating the terms of trade, which is very unfavorable. So in my view, there's a limit to a system like that, unless you recreate the kind of economic area that the Comecon was materializing. So the currency becomes a sort of clearing instrument inside an economic area. But if you want it to be a real currency, then people must be able to use the balance they accumulate. And that's for the moment absolutely not the case. Now the other case is where you have a deficit in currency, and that's vis-à-vis China. And then China lends you the currency to pay them back. And that's what's happening now. There's a lot of noise made around the swap agreements that China is concluding with a lot of countries, but those swap agreements are used to pay for Chinese import or for paying back the debt to China. And one paper, which I think was slightly misguided, said these are liquidity lines, or China is providing liquidity support. No, China is just providing instruments to pay them back. That's why they don't want, by the way, rescheduling the debt. They're refinancing the debt through swap lines. But again, that's just China giving credits to people to pay for import from China. So the whole narrative about the renminbi becoming an international currency seems to me a little bit artificial from that perspective. The renminbi will become an international currency the moment countries which have positive balances in renminbi can use them to pay for something else that Chinese good. Then, of course, you have an incentive to accumulate them, and the synergy between medium of exchange and store of value develops. But for that, China will have to create an area where other countries, like apart from China, would accept renminbi as payment. It may occur in a matter of a decade or 2 decades. It will depend on how economic geography and political geography structure itself. But I may be wrong, but I don't see that coming in the next decade or so.
Thank you. To conclude, I'd like to conclude with you, Harold, and I'd like to pose, to do a provision like Robert Mundell, but not making into a Nostradamus type of prediction. So the question, the prediction is, and I'd like to turn it to the audience, but I'd like to ask you, which time frame will you pick for saying the dollar will remain the key international currency in, obviously Mundell says, in his lifetime, but we said we don't want to use this. What would you pick? 10 years, 20 years, 30 years, mid-century?
I mean, I think the answer really depends on how rapidly we think that the IT and AI revolutions are going to culminate in a really fundamentally transformational experience. And in that sense, I wouldn't want to push it as far as Mundell said, the next 50 years or so. It seems to me that there are technical developments. And, I think it's nice to think about this right at the end of a session like this, that what is money when Jean-Pierre talks about how we use money. Money is a way of translating needs. And so, in a way, the story of money as a translation system is really like the story of the development of translation of languages. And we're just seeing at the moment what colossal improvements are made in that area where we can really translate. And soon we won't need these kind of systems, and we won't need somebody mechanically to tell us what a speech in a different language means. That's the kind of revolution that I think would lead to the end of the dollar.
So basically, as you said at the beginning, 30 years, so we take the Armenian dram, is far too long at this point. So 30 years ago, there was the unknown of digital money. Now we know. And let's say the smartphone was invented in 2007. So let's compromise 15 years. So I'd like to turn to the audience here. And please put your hands up if you think then the dollar will remain as the key reserve currency, the key international currency in 15 years. So in Relative decline, but I think maybe it doesn't matter if it's split. Yeah. US, no, say international. International means still top reserves, top payment thing. So hands up, 15 years? Yeah, okay, I would say the majority in this room thinks then. So I believe that everybody is going to store dollars for the next 15 years if you are consistent with it. Sorry? For 50 is a bit too long. It's probably needs to become like Mandela prediction, Nostradamus, as Harold said. So we conclude this session here, and I would like to thank our participants, our speakers, for these brilliant remarks and presentations. And then on behalf of all the foreign participants, I would like to thank the President of Armenia and the Governor of the Central Bank for your legendary hospitality. I read